You know, it's pretty wild when you actually picture it. Warren Buffett's early office, where all this magic started, could fit inside like less than half a tennis court.
Hmm.
And get this, no computers buzzing away, no stock tickers flashing, just apparently 11 people really digging into the fundamentals.
It really paints a picture of a different time, doesn't it?
Hmm.
A time when maybe truly understanding the business, the numbers, was even more critical without the constant flood of data we have now.
Absolutely. And that's exactly what we're getting into today. We're going deep on Buffett's core approach, pulling the key ideas straight from the book, The Warren Buffett Way.
Yeah, think of this as sort of a shortcut to understanding the bedrock principles behind his success.
Right. The book itself, I mean, it's got endorsements from heavy hitters like Peter Lynch, John Bogle. They both say it's essential for understanding Buffett's lasting principles.
And that's the key word, lasting. The book makes a strong case that these core ideas haven't really changed, even when the markets go completely haywire.
Oh, definitely. You think back to the dot-com bubble, right? And the crash afterwards.
Hmm.
Buffett's philosophy, which this book lays out so clearly, it was like uh, a steady anchor, as the book puts it, while everything else was just, well, chaos.
Exactly. So the mission here, for you listening, is to pull out those actionable bits, understand the why behind Buffett's consistency, and, get you feeling well-informed without getting lost in all the jargon.
Okay, so where did these principles actually come from? The book dives into his early influences, and Benjamin Graham is obviously top of the list, the dean of financial analysis.
Right. Graham's big contribution through books like Security Analysis and The Intelligent Investor was really defining what investing is.
He drew a very clear line, didn't he, between investing and just, well, gambling or speculating.
Precisely. He said an investment has to promise, first, safety of your principal, and second, a satisfactory return. And critically, that promise has to be based on solid analysis.
Anything else is speculation.
Anything else is speculation. It's about a reasoned approach, not just hoping the price goes up.
And flowing from that came his idea of the margin of safety, which sounds simple, but it's fundamental.
It really is. The book explains he wanted this cushion, this buffer, against mistakes or bad luck for both bonds and stocks.
Okay, so for bonds, it was about earnings being way higher than the debt payments.
Right.
A big cushion.
Exactly. Plenty of room if earnings dipped. But applying it to stocks was a bit trickier.
How did he tackle that?
He focused on the difference between the stock's market price and what he called its intrinsic value.
Intrinsic value being what the company is actually worth based on the facts. Assets, earnings, dividends, future prospects, all that.
That's the idea. Find that value, then buy the stock for significantly less. That gap is your margin of safety.
Okay, so that's Graham. Then the book brings in Philip Fisher. He had a slightly different angle.
Yeah, a complementary one. While Graham was big on not losing money by buying cheap, Fisher was more focused on finding companies with, outstanding potential, great growth prospects, really strong management. So finding the winners, not just the bargains.
Kind of. He looked for sales growth that was consistently better than the industry average, often linked to, strong R&D plus a really effective sales force. Because great products don't sell themselves.
Makes sense. And it wasn't just sales growth.
No, no. He was equally focused on profitability, consistent profit margins, keeping costs under control, good accounting. You need that solid foundation for growth to be sustainable.
And Fisher also pushed this idea of sticking to what the circle of competence.
Absolutely. Don't stray into industries you don't truly understand. And he wasn't a fan of spreading your money thin. He believed in concentrating your bets on a few really excellent companies.
Fewer bets, but higher conviction. The book mentions his portfolios often had, fewer than 10 stocks? Sometimes, yeah. With a lot riding on the top few. You can definitely see that influence on Buffett's later approach.
Okay, influence number 3 the book highlights is John Burr Williams. His big thing was
His doctoral dissertation, The Theory of Investment Value. It sounds academic, but it laid the groundwork for a lot of modern valuation thinking.
and the key concept from Williams.
It's basically the dividend discount model, or you could call it discounted cash flow analysis. The idea is a stock's value today is based on all the cash you expect to get out of it in the future, discounted back to the present.
So primarily dividends or maybe earnings reinvested that become dividends later.
Exactly. As Williams put it, a stock is worth only what you can get out of it. It forces you to think long-term about the actual cash generation of the business.
Got it. Graham, Fisher, Williams. And then there's Charlie Munger. The book really stresses how vital that partnership
Oh,
is.
it's impossible to overstate Munger's influence. They're not just friends. Munger is vice chairman at Berkshire, very much a co-managing partner,
You see it in the annual reports, right, Charlie and I think?
all the time. The book points out how Munger really pushed Buffett beyond just the pure Graham cigar butt investing towards appreciating truly great businesses, even if they weren't statistically dirt cheap. A massive influence.
Okay, so those are the intellectual building blocks. How did Buffett actually put them to work? The book looks at Berkshire Hathaway's history, starting with the early Buffett partnership.
And the results there were just, well, staggering. Over 13 years, it compounded at 29.5% annually.
Wow. Compared to the Dow?
Blew it away. The
Yeah.
Dow even had down years in that stretch. The partnership never did. Buffett initially aimed to beat the Dow by 10 points a year, and he just smashed that target.
So early proof of concept. And the book highlights the American Express investment in '63 as a classic Graham example.
Textbook Graham. Amex got hit by this huge scandal, the salad oil scandal, if you remember.
Vaguely. Stock price tanked.
Plummeted.
Yeah.
But Buffett saw the underlying business was still strong, just temporarily tarnished. So he jumped in big time.
How big?
He put 40% of the partnership's assets into Amex.
40%. That takes conviction.
Huge conviction. And the book notes the stock tripled in about 2 years. Pure value investing buying fear when the analysis supports it.
Looking at Berkshire itself, the long-term average gain, like 22% a year from '65 to '03, is incredible. But the book also points out it wasn't a smooth ride year to year.
No, definitely not. It could be quite volatile and sometimes lag the market significantly. The book uses the late 90s as an example. Berkshire underperformed in 99 when tech was booming because Buffett stayed away.
Right, sticking to his circle of competence, even if it meant missing a temporary party.
Exactly, which leads nicely into Geico. The book talks about Buffett's fascination with Geico going way back. He loved their simple, smart model.
Insure good drivers, sell directly, cut out the middleman, lower costs.
Simple but revolutionary at the time. And crucially, the book emphasizes the float Geico generated. Those premiums collected upfront that can be invested before claims are paid.
Ah, yes, the magic insurance float, a huge source of investment capital for Berkshire.
A massive source. And Geico was eventually fully acquired by Berkshire, a cornerstone investment.
Then there's General Re, the reinsurance business. More float.
More float, yes. The book explains reinsurance, and again, the ideal goal of negative float cost, meaning the underwriting itself is profitable. You get paid to hold the money.
But genre had some issues initially. The book mentions underpricing.
It did. Buffett was quite candid about the problems, the underpricing, and the huge hit from 9/11. He admitted it took work to get genre performing properly.
But it eventually did well. And Ajit Jain, who runs the reinsurance side now, is someone Buffett clearly admires hugely.
Immensely. The book highlights Jane's skill, and it also mentions National Indemnity as another example of disciplined underwriting, thanks to his founder, Jack Ringwald. Only write business when the price makes sense. Don't chase volume for volume's sake.
That discipline seems key. Now, the book also talks about Buffett buying entire businesses, not just stocks. This gives a different perspective, right?
It really does. You see examples like Ben Bridge Jeweler, where keeping the family management was crucial, or Justin Industries, Justin Boots, Acme Bricks.
Acme Bricks is interesting, building a brand, a moat, in something like bricks, which seems like a commodity.
Exactly. The book uses it to show how strong branding can create an advantage even there. Then you have Benjamin Moore Paints, Shaw Industries and Flooring, Clayton Homes.
Clayton Homes deal was fascinating, basically done over the phone after reading a book about the CEO.
Pretty much. It showed Buffett's focus on management quality and avoiding what he calls the institutional imperative, like pushing bad loans just because competitors are. Clayton had incentives against that.
McLean, the distributor, was a strategic buy for growth. And the Pampered Chef highlighted good management and consistent growth again.
Yeah, the book boils down Buffett's acquisition criteria to 3 things. Can I understand the business? Does it have good economics? And is management trustworthy?
Simple but powerful. Okay, so most of us aren't buying whole companies. How does this apply to buying stocks? The book brings it back to familiar territory.
Right back to basics. Invest in businesses you know and understand, like Coca-Cola. Buffett knew the brand forever, waited patiently, then invested heavily.
Gillette, too, a turnaround, but based on dominant brands and innovation like the sensor razor.
Yep. And Wells Fargo is presented as more of a classic value, play good bank, bought when the stock was beaten down, offering a big discount to its real worth.
The Washington Post investment gets special attention, too. His relationship with the Grahams, the huge return.
Huge return, yeah. And it really cemented his reputation early on. The book even connects it to his family's newspaper background, giving that deeper understanding.
So these examples really set the stage for the book, breaking down Buffett's specific guidelines. It splits them into 4 areas: business, management, financial, and value tenets. Let's start with the business tenets.
Okay, first one. Is the business simple and understandable? This is why he famously avoids complex tech he doesn't get.
Makes sense. Second,
Does it have a consistent operating history? He generally steers clear of companies trying massive, risky turnarounds.
stick with proven performers. And third,
Favorable long-term prospects. This is where that economic franchise idea comes in businesses with a wide, sustainable moat protecting them from competition.
and a key test of that moat is pricing power, right? Can they raise prices without losing customers, like maybe Acme Bricks managed to do?
Exactly. That's a strong sign of a moat. Okay, then the management tenets. First, is management rational? Especially with how they allocate capital. Do they reinvest earnings wisely? The book points to Doris Christopher at Pampered Chef as a good example.
Okay, rational decisions, what else?
Are they candid with shareholders? Do they admit mistakes? Buffett himself did this publicly with General Ray.
Transparency, got it. And the third management point.
Resisting that institutional imperative.
Yeah.
Avoiding dumb decisions just because everyone else is doing it. Jack Ringwalt walking away from bad insurance deals. Clayton Holmes not making bad loans. Those are the examples.
Avoiding lemming-like behavior. Okay, next. Financial tenets. What numbers matter most?
Big one. Focus on return on equity, ROE, not just earnings per share, EPS. ROE shows how effectively management is using shareholders' money.
And calculate owner earnings. That's a bit different from standard accounting.
Yeah, it's net income plus depreciation amortization minus the capital expenditures needed to maintain the business long term. It's a truer measure of the cash owners could theoretically take out. The book warns against just using simple cash flow numbers, which can be misleading.
Okay, owner earnings. Also, look for high profit margins.
Consistently high margins, yes. And a final check. For every dollar the company keeps and reinvests, does it create at least $1 in market value over time?
A test of that reinvestment skill. All right, that brings us to the value tenets. This is where it all comes together.
Pretty much. First, you have to estimate the intrinsic value of the business. What's it really worth? The book mentions the dividend discount model, but notes Buffett simplifies by using a consistent discount rate, like 10%, now focusing on the certainty of the cash flows rather than complex risk adjustments.
Interesting. So value it, and then the final step.
Can you buy it at a significant discount to that value? That's your margin of safety again. The book uses Larson Jewell, the picture frame company, as an example, buying a solid business during a temporary slump.
Okay, so we have the principles, the guidelines. How do we actually manage a portfolio this way? The book talks about focus investing.
Right, which basically means not diversifying excessively. Concentrate your investments in, say, 10 to 20 companies that you understand really well that meet those business, management, and financial criteria, and that you bought at a good price.
Fewer, better bets again, and this requires patience.
A lot of patience. You need a long-term view, 5–10 years minimum. Ignore the market's daily gyrations. This is totally different from active trading or even standard modern portfolio theory with its emphasis on wide diversification.
The book mentions the super investors of Graham and Doddsville, right? Showing how Buffett's peers using similar concentrated value approaches also outperformed over the long haul.
Exactly. Munger, Bill Ruan, Lou Simpson, they all had periods of underperformance, but their long-term records were stellar, supporting the focus investing idea.
And a big benefit is lower turnover.
Huge benefit. Fewer trades mean lower costs, obviously, but maybe more importantly, lower taxes. You let your winners run and compound tax deferred for longer.
Makes sense. But analysis isn't everything. The book dedicates space to the psychology of money. Why is that so important?
Because markets aren't perfectly rational. Investor behavior, driven by fear and greed, creates those opportunities Graham and Buffett look for. But it can also trip you up if you're not careful.
Yeah, we all feel that pull sometimes. The book mentions things like overconfidence, availability bias.
Anchoring on past prices, hating losses more than enjoying gains, loss aversion, mental accounting tricks we play on ourselves, and the intense pressure on professional managers to show short-term results, which can lead to bad decisions.
And Buffett and Munger are aware of all this.
Acutely aware. The book says they see these huge, predictable patterns of extreme irrationality and try to use them to their advantage while making sure they don't fall victim themselves. It mentions Richard Thaler's advice. Maybe just don't open the mail too often if market swings make you anxious.
Huh. So emotional discipline is just as vital as the analysis.
At least as vital, maybe more so sometimes, which ties into the idea of Buffett as the unreasonable man. He doesn't follow the crowd.
Meaning, ignore the market noise?
Pretty much. Turn off the stock market ticker. Don't make decisions based on what the market is doing day to day or based on forecasts about the economy.
Don't predict the economy.
Nope. Buy good businesses that can do well in any reasonable economic environment. Think like you own the whole business, not like you're just renting a stock certificate for a few months.
Sure.
Focus on business results, not stock quotes.
So the book emphasizes investing is simple, but not easy.
Exactly. The concepts aren't rocket science. But having the accounting knowledge, the right temperament, the discipline, and staying in your circle of competence, that's the hard part.
The book even includes the author's own story of trying to strictly apply the Buffett way and the challenges faced, like finding great companies that aren't already mature, the patience needed.
Yeah, it's a dose of realism. And it acknowledges that value investing evolves. You can find value in growth companies too, not just statistically cheap ones. The key is always understanding the business and demanding that margin of safety.
But the core principles themselves are timeless, applicable anywhere.
That's the main argument. Across industries, company sizes, countries, the fundamental logic holds true. Understand the business, management, financials, and value.
Okay, so let's wrap this up. For you, the learner, the big takeaways from our dive into the Warren Buffett way really boil down to this. Understand the business inside out. Assess the management's quality and honesty. Dig into the financial health. And then be patient and disciplined enough to buy only when there's a significant discount to its real value.
And crucially, layer on top of that a long-term mindset and the emotional steel to ignore the market's short-term craziness.
Right. And as the book shows over and over, these aren't just theories, they're principles that have proven incredibly resilient through decades of market ups and downs.
Which we really have endured.
So here's a final thought to chew on. What if you tried consciously adopting just one or two of these tenets? Maybe committing to only investing in businesses you genuinely understand, or truly shifting your focus to a 5 or 10-year horizon instead of the next quarter. How might that alone change your perspective? Maybe make you feel more confident in your financial decisions, and perhaps dig a little deeper yourself into figuring out intrinsic value and spotting those durable competitive advantages, those economic moats.